Hey guys, Joel Seach here, Harpel Financial Group. Welcome back to the last market update of the end of the year, 2022 calendar year, as it draws to a close. It's been great to be able to bring you some updates during the year in terms of keeping everyone abreast of the market and keeping you up to date as to the ups and downs. A few more downs and ups this year in the year that was 2022, with all the craziness that is the market. And also just to wish everyone a Merry Christmas as well. I guess in terms of recapping where we're at from where we've been, some of the key points and the key themes for the year that we just come through, it was dominated by high inflation and rising interest rates, the war in Russia and Ukraine at the start of the year that's carried on, and then that pushing into recession fears and that inflation drama. Obviously, inflation coming through, and then Ukraine and Russia adding to those pressures as well, with energy prices and food prices really ramping up. So that hit bonds and shares hard. There was no really to hide from an asset class perspective, and then that drove losses for just even a balance to a growth fund or an investment profile. 23 is likely to remain volatile. We'll have a retest of some 2022 lows. Bearing in mind, even of late November and the start of December, we saw some rebound in the market, so it can turn really quickly when it does turn. So it's always important to keep that perception and perspective, I should say, on the medium and long-term approach, generally speaking. So the shares will be still up and down. We should have some easing in inflation, we hope. The central banks hopefully getting off the brake and turning a bit more dovish than hawkish, so starting to potentially even look at easing some interest rate hikes. They should be close to their peak now for the Reserve Bank of Australia domestically in Australia. Abroad, there's probably still some room to move as well. And economic growth should be likely stronger than first feared, and some improved valuations should hope for some better returns. The property prices, depending on where they're located, they'll be up and down as well. They've had some tightness occur just due to the interest rates going up and people having less cash to spend. The main thing to keep an eye on is inflation. So central banks and interest rates and what happens there. A lot of people coming off fixed loans as well and seeing how that enters into the market in terms of a cash flow side of things. US politics is a big one geographically. China tensions and what they do with their COVID policy over there, and how that then impacts the rest of the world. And then just property prices in general, we'll see where they go. I guess in terms of some of the updated information, and you'll see attached to this email as well, is a bit of a graph with market trends as to where they were 2021 and the asset classes and how much of a fantastic year it was. 2022 and how there's a lot of negatives there, and it was quite a challenging year. That was up to November and end of November 2022, which is from Morningstar. And then a bit of a forecast, again, to take with a grain of salt for next year as to where we feel maybe subdued returns might be, and then overall maybe an averaged out return. The one thing that we can see from things is the volatility that's been in the markets is still there, from great year 21 to a really tough year 22 to potentially a return to some positivity in 23. I guess some of the dot points to keep an eye on there in terms of the graph that you'll see there, or the table that you'll see in your email there, is the global shares had a very rough year. So they had a plunge of 23% into October, just on inflation and interest rate worries. Chinese shares led a lot of weakness, not helped by the COVID policy being zero. So Asian shares, given their exposure to China, had a lot of sensitivity there. Aussie shares actually outperformed a little bit, so strong commodity prices and energy prices, and relatively a little bit less hawkish RBA, and just being a bit more separated from the rest of the world in terms of us being able to self-sustain as a country and an economy. Government bonds, or bonds in general, have one of their worst periods of time. So that was, I think the worst, Australian bonds, the worst year since 1973 or the 1930s. So that's just due to yields surging. So those bonds became less valued, high inflation and rate hikes. So unlikely to see bonds take such a hit as they did this last year. But overall, I guess in summary, it's been a very, very crazy year in terms of the market. The ups and downs we've experienced has been a roller coaster, more downs than ups. Again, short-term perspective, it's really hard to put too much weight into a short term. But as we continue to go from an investment standpoint, time in the market and diversifying is the key, because when those returns come, they turn really quickly. And it just goes to show that things can turn on a dime very, very quickly. So we'll see with those dot points that we've mentioned in the table there as to what occurs with the markets coming into 2023. But hopefully you've all had a great year, returning to a bit more normality in Australia and being back out and about, and have a really safe Christmas and festive season with yourself and the families and your families. We look forward to catching up with you all in 2023. Have a really good one and a safe time away if you're going travelling. Look forward to speaking to you and catching up as we go through into the new year of 23 at Harpel Financial Group. Thanks, guys. Take care.